Henkel Henkel's preferred stock in Germany, has just printed a buy signal on both the 2-day and 3-day charts. But the important point is this: the signal is not appearing after a strong breakout. It is appearing after a sharp decline near the lower price area, around the 64 to 67.3 euro zone. So the real question is this the beginning of a bottom recovery, or is it only a short technical bounce before another leg down? In this video, I will break down 3 key things: the buy zone at 64 to 67.3, the upside targets at 71 to 74 and 75 to 79, and the risk zone at 62.5 to 61.5. Where this recovery setup could become weak. This is educational content only, not financial advice. Now, let's start with the company first. KGaA is the preferred share Henkel AG and Company KGaA, a major German company. Henkel is not a speculative small-cap stock. It is a large-cap European company with a market value around the mid-20 billion euro range. The company operates mainly in 2 important business areas. The first one is adhesive technologies. This includes adhesives, sealants, bonding solutions, and functional coatings used in industrial production, packaging, transportation, electronics, construction, and many other areas. The second one is consumer brands. This includes laundry, home care, and hair-related products. So Henkel is a mix of industrial exposure and defensive consumer demand. This is important because Henkel is not the same type of stock as a fast-growing tech company. It is more defensive, more mature, and usually moves in a more controlled way. So when we analyze this stock, we should not expect the same explosive movement as a small technology stock. Now let's move to the chart. On the 2-day and 3-day chart, the stock has shown a buy signal around the 64 to 67.3 euro area. This zone is important because price is trading close to a lower support area after a strong decline. When a buy signal appears after a strong drop, I do not immediately call it a breakout. I classify it first as a possible bottom recovery setup. A true breakout would need the stock to push strongly above resistance, hold that level, and continue with stronger candles. Right now, this looks more like the early stage of a recovery attempt. The first key area to watch is the upper part of the buy zone, around 67.3. If price can hold above this level, it would be the first sign that buyers are trying to regain control. The next upside zone is 71 to 74Z. This is my first target area. If the stock moves into this zone, traders should watch how price reacts. If the candles become weak, or if the stock fails to hold above this area, then it may only be a short-term bounce. But if price breaks above 71 to 74 with better momentum, then the next target zone becomes 75 to 79. This is the second target area, and it would represent a stronger recovery from the bottom. However, the most important part of this setup is not only the target, it is the risk. The key risk zone is 62.5 to 61.5. If price breaks below this zone, the recovery setup becomes much weaker. In that case, the buy signal may fail, because price would be losing the support structure created after the recent decline. So the structure is simple. As long as price holds above the lower support area, the recovery setup is still alive. If price moves above 67.3, the first upside zone is 71 to 74 if price continues above that area. The second target is 75 to 79. But if price breaks below 62.5 to 61.5, the signal becomes weak and the risk increases. Now let's talk about the fundamental side. Henkel is a well-established German company. Its business model is more stable than many high-growth stocks because it has exposure to both industrial customers and consumer products. The adhesive technology segment is especially important because it connects Henkel to many industries. Adhesives, sealants, and coatings are used in packaging, automotive, electronics manufacturing, and construction. This gives Henkel industrial exposure. On the other side, the consumer brands segment gives Henkel more defensive characteristics. Laundry care, home care, and hair products are categories with relatively stable demand compared to more cyclical sectors. This combination makes Henkel a mature, large-cap company. But it also means that growth may not be very fast. Investors should not treat this like a high-growth momentum stock. The opportunity here is mainly based on the chart recovery from a lower price area. The fundamental profile gives the stock stability, but the technical chart is what gives us the timing. So my conclusion is this: Henkel _P is showing a buy signal on both the 2-day and 3-day charts. The signal zone is around 64 to 67.3. This is a possible bottom recovery setup, not a confirmed strong breakout yet. The first target area is 71 to 74, the second target area is 75 to 79. The key risk zone is 62.5 to 61.5. If price breaks below that area, the recovery setup becomes weaker and the buy signal may fail. For now, I would watch whether Henkel can hold above the buy zone and move above 67.3. That would be the first step for buyers to confirm this recovery attempt. Again, this is educational content only and not financial advice.